Price delay and market frictions in cryptocurrency markets. Price delay and market frictions can indeed occur in cryptocurrency markets, just as they can occur in traditional financial markets. While cryptocurrencies offer several advantages, such as decentralized transactions and global accessibility, they also face unique challenges that can lead to price delays and market frictions. Here are a few factors that can contribute to these issues. 1. Lack of liquidity. Liquidity refers to the ease with which an asset can be bought or sold without significantly impacting its price. Cryptocurrencies with lower trading volumes or those that are newly introduced may suffer from limited liquidity. When there aren't enough buyers or sellers in the market, it becomes challenging to execute large orders without impacting the price. This can lead to price delays as traders wait for suitable counterparties to match their orders. 2. Fragmented exchanges. Cryptocurrencies are traded on various exchanges, and each exchange operates independently with its own order book and liquidity. This fragmentation can result in price discrepancies across exchanges. Traders may exploit these differences through arbitrage, which involves buying low on one exchange and selling high on another. However, the process of transferring funds between exchanges can be time-consuming and subject to delays, hampering efficient price convergence. 3. Market manipulation. The relative immaturity of cryptocurrency markets, combined with lower regulatory oversight, can make them susceptible to market manipulation. Manipulators can engage in activities like wash trading, simultaneously buying and selling to create artificial volume, spoofing, placing large orders to deceive other traders, or pump and dump schemes, inflating prices and then quickly selling. These practices can distort prices, create false market signals, and cause price delays as genuine market participants navigate the manipulation. 4. Technical limitations. The underlying blockchain technology of cryptocurrencies may encounter scalability and latency challenges. During periods of high trading activity, the networks can become congested, leading to slower transaction confirmations and delays in price updates. Scalability issues can affect the speed and efficiency of order execution, resulting in market frictions and delayed trades. 5. Regulatory uncertainty. Cryptocurrency markets operate in a regulatory landscape that is still evolving and varies across jurisdictions. Uncertainty regarding how cryptocurrencies will be regulated can create frictions in the market. Traders and investors may be hesitant to participate due to concerns about legal compliance, tax implications, or the potential for regulatory changes. Such uncertainty can lead to price delays as market participants wait for clearer regulatory guidelines before engaging more actively. 6. Lack of institutional participation. Compared to traditional financial markets, cryptocurrency markets have relatively lower institutional participation. The absence of large institutional investors and market makers can contribute to lower liquidity levels and wider bid-ask spreads. Without the presence of these participants, who typically provide liquidity and absorb large trades, price movements can be more volatile and price discovery may be delayed. It's worth noting that these factors are not exclusive to cryptocurrency markets, as some can also be observed in traditional financial markets. However, the unique characteristics and challenges of the cryptocurrency ecosystem can amplify these issues, leading to price delay and market frictions. 7. Lack of market regulation. Cryptocurrency markets often operate with less regulatory oversight compared to traditional financial markets. The absence of robust regulatory frameworks can create an environment where fraudulent activities and market abuses can thrive. This lack of regulation can result in price delays and market frictions as traders face concerns about the integrity of the market and the potential for unfair practices. Without clear rules and enforcement mechanisms, investors may hesitate to participate actively, leading to reduced liquidity and slower price discovery. 8. Market sentiment and news impact. Cryptocurrency markets can be highly influenced by market sentiment and news events. Positive or negative news about cryptocurrencies, regulatory developments, or security breaches can trigger significant price movements and volatility. Traders may hesitate to act immediately in response to news, causing price delays as they assess the impact and direction of the market. Moreover, the rapid spread of information through social media and online communities can amplify market sentiment and exacerbate price delays due to increased trading activity and order congestion during periods of high market interest. These additional factors contribute to the overall price delay and market frictions in cryptocurrency markets, adding to the complexity and challenges faced by traders and investors in these environments. At last, don't forget to subscribe our channel.